Well, first of all, thank you so much, Mark. My name is Morris Matt, and I'm the president of Matt and Associates Financial Solutions. You'll see my partners Brad Wendt and Chris Matt up top there. And we're super excited today to offer all of our clients an amazing opportunity to hear from some of Canada's leading experts in the financial markets. Mark Shimim, who you'll see in the corner of your screen there, is a district vice president for Manulife Investments and 2024 year partner with us in the business. And because of our tenure with Manulife, we've been really blessed to have access to some of these professionals. Our firm is reaching a milestone in a year or two here, about 30 years in the industry. And we're really trying our best to walk with you, our clients, through good and bad markets. And as many of you've known, we've been through so many cycles together, and this is just another one of them. And we've got a really good turnout today of clients and friends and family. So if you don't know us, we welcome you to our group here. And we're excited to share with you some information today. And what we're going to try and do is actually have this happen 3, maybe 4 times per year. We'd really like to bring you an added level of service and support, and in addition to our newsletters and our in-person meetings that we regularly do. So again, thank you so much for everybody showing up, and we're just going to really enjoy this. I'm going to pass it off to my partner, Brad, and he's going to share a little bit more with you about what we're going to have today.
Yeah, thanks, Phil. This is a very cool opportunity here to have both Kevin and Jonathan on the same call. So Kevin's going to be doing a bigger picture presentation on what's going on with the economy and how everything is kind of flowing and working in that regard. And then there's going to be a little more in-depth on how the day-to-day management of these portfolios work with Jonathan Popper. So it's really cool to see how both these two guys and these teams work together to ultimately manage the money through these different times and keep everyone on track.
Before we start, we have a few housekeeping items I'd like to talk about. So like Mark said, this will be recorded. So if you guys have see any value here that your friends and family might like to see, we'll share it with you afterwards, and please feel free to share it with them. Again, like Mark said, please feel free to ask any questions in that question and answer box below. You can type them in. And we'll have 2 periods following both Kevin and Jonathan's presentations to answer those questions. Any questions that we don't get to answering, we will respond to you right after and reach out to get those answers to you. All right, Mark, if you want to get this call started, you can introduce both Kevin and Jonathan. Take it away.
Perfect. Thanks a lot, Chris. Thanks, everybody. Really do appreciate being part of your business. I mean, Matt and Associates is a really important part for Manulife, and we want to make sure that the flow of information to you is consistent and it's steady, and we get you the best information that we can. So we've got some great speakers today coming to you to talk about a whole range of things. Brad had mentioned we'll start with Kevin Headland. Kevin Headland, he's our Chief Investment Strategist at Manulife Investment Management. I've had the pleasure of working with Kevin. I think we're now getting maybe 20 years, I think. And what I like about Kevin's presentation is just about the world, the economy, the markets. We want to distinguish between what is the market, what is the economy. We also want to talk about some of the good news that's out there in the world. If you keep focusing on the media, we all know what the purpose of the media is. Yes, definitely to give us some, information, but they do want to sell advertising space in order for them to make their money. So there is a little bit of a bias to the negativity out there, because we seem to be attracted to that for some reason, more than the positive. But there are a lot of positive things out there, and Kevin's going to talk to you about the real information out there for the economy and the markets to help you just get a better feeling out there, because I know this year has been quite difficult market-wise, but it's also been difficult because we've been coming off a 2-year kind of strange world, and the markets are definitely reflecting that. So we want to make sure we give you a clear, positive view. After Kevin speaks, We're going to have Jonathan Popper. Jonathan Popper is senior portfolio manager, managing director at Manulife Investments. He's one of the long-standing members of the Essential Equity team, managing many billions of dollars in all market conditions. I think Jonathan almost 20 years as well too, at Manulife. So I think it'd be really interesting to hear from how somebody manages money in all types of markets, whether it's a growing market, a bear market, or where we're in right now, an inflationary environment. So I think that's going to be really good for you to hear about how the professionals manage money. As we mentioned, there's some questions. Please feel free at the bottom, answer or ask all questions that you might want. There is no question that is a wrong question or a question that is some people might say an unintelligent question, because all questions can be turned into something of good information towards you. And I will ask those on your behalf. So don't worry about that. I will monitor the questions and ask. We'll have a session of questions after Kevin speaks. Then I'll introduce Jonathan again. He'll go through his session, and then there'll be a session of questions afterwards. So enjoy, everybody. There's some great information here. Thank you very much, Mo, Brad, and Chris, for having us on. Kevin, thanks for coming. Jonathan, thanks for being here as well too. So I will pass it over to our Chief Investment Strategist, Kevin Headland.
Thanks so much, Mark, and thanks everyone for joining us today. Good morning. It's afternoon here in Toronto, but good morning to you on the West Coast. Again, Mark, thanks for aging me so much that I've been working with you for 20 years now. I've been doing this for just over a dozen years now, so it's I've seen a few cycles as well, and been through some rocky periods before. For my friends and family who don't know what I do for a living, for a career, I try and describe myself as a meteorologist for the markets. Just like meteorologists, we are trying to predict the unpredictable. There's no guarantees in weather, and there's no guarantees in the markets. But we have our experience, we have our education, we have our research, we have our data, and that allows us to try and give a belief on where things are going. You know, the trends are they improving or are they decelerating? And we try and make sure that things are at least a high probability, right? Markets are a probability game, just like weather is. And we believe with a high degree of probability where markets are going in the near term. Coming into this year, we were fairly optimistic of the year for the whole year. We kind of characterized 2022 expectations as we're kind of like a road trip. You get everyone in the car, you pile in the luggage. The destination is going to be a lot of fun, right? It's why you're going there. But it takes time to get there. And like any road trip, there's pit stops along the way. Some expected, some unexpected. This year has been full of pit stops, some longer than expected, some longer and deeper than expected. We expected the central banks to start to raise rates, perhaps not as fast as they have, but we expected that to start. We did not expect an invasion in Ukraine by Russian forces. You know, that was an unexpected pit stop. So we're always seeing these expected and unexpected pit stops, but we've got to be mindful of the destination. The famous country singer Brad Paisley came out with this quote, and we like to use quotes and analogies often in our material. And this quote was, if you make the mistake of looking back too much, you aren't focused enough on the road in front of you. And I think it's really important in investments. You know, there's a reason why the windshield of a car is bigger than the rearview mirror. While it's important to know where you've come from, it's more important to pay attention to where you're going. And that is true also for investments. We want to know where we've come from, but the focus has to be on the future. We want to make sure that we're looking ahead and not too focused on what has already transpired. So in the vein of looking ahead, where do we see things? You know, as Mark alluded to, our team looks at things from a bigger picture perspective. We're looking at things from a 30,000 foot view. We're not managing money and buying stocks like Jonathan and his team. We're looking at things on a broader picture, trying to give information on where the opportunities or risks might exist. So from a global perspective, we know things are weakening. We know the economy is getting weaker. The US economy just announced a second quarter of negative GDP, and that would define a recession. However, that's a very broad-based definition. That is not the true nature of what a recession is. When we look at data, we definitely see things are slowing. Here's a chart of what is called the leading economic indicator index. That is essentially a monthly index that is put together using 10 sub-economic indicators. Those 10 indicators have proven over time to give a good lead into where the economy is going. So essentially for this line, we want to see, excuse me, if the blue line is going up, things are getting better. Blue line coming down, getting weaker. Clearly on the right-hand side of this chart, things are getting weaker. However, it's rare to see a recession that those gray bars until that blue line is below zero. We're not there yet. So we do not believe we're in a recession just yet. Now, to use a baseball analogy, we might be in the 7th or 8th inning of this economic cycle. The game's not over yet. It might go into extra innings. But the key is, what do we do about it? Have the markets really fully priced in a lot of the risk already? Is most of the risk already behind us? And we would argue that yes, the pull down and the drawdown in the equity markets have likely already priced in a lot of this anticipated or expected economic weakness. We do not believe we're in a midst of a real deep risk of recession. Those deep recessions that we feel like 73, 74, or in the great financial crisis, or during the dot-com crash, those were really associated with rises in unemployment, big jumps in unemployment, where really it was consumption that stopped. Right now, employment remains very strong and resilient in most markets, especially the US and Canada. The US unemployment is at 3.6%. You know, it comes out with their most recent data tomorrow, expected to be a little slower, but still not much change in the unemployment rate. That remains extremely strong. And 3.6% remains near long-term lows. You have to go back to the 60s before you see 3.6 or lower. So that's quite important to realize that that is extremely low and positive. Even if inflation is elevated, we've seen that, people still have jobs. Their dollar of income is not going as far as it used to, but at least they still have that dollar of income. That is important to understand. We believe that this is not a deep recession as a result of a jump in unemployment. Weaker economic growth, yes, likely going to get a recession at some point over the next 12 months. But once again, a lot of that risk has already been priced in. It's always about expectations, and we can see that coming. We can see the risks. We also believe inflation is nearing peak levels. We expect that to start to come down. Obviously, there's some factors in inflation that are uncontrollable or unpredictable, such as the increase in food costs and energy costs as a result of the invasion in Ukraine, the supply chain disruptions as a result of COVID and the continued issues, especially with China and zero COVID policy and the transportation of goods around the world. But we're starting to see improvements in other areas. Even energy costs have come down. Commodity costs have come down. We're starting to see improvements in those numbers, and we expect inflation to start to slow. We're not going to get down to that 2% level anytime soon, but if we start to see improvements, that is important. That is where we want to see things. And the central banks raising rates has helped, and is expected to help to reduce some of that inflationary pressure, but also the weakness and the slowdown in the economy is also going to slow down that demand, which should again also put some downside pressure on inflation. So we should see some improvements there. So that is another tailwind potentially for equity markets and fixed income as we move forward over the next 12 months. Of course, as humans, the biggest obstacle to investing is the space between our ears, right? We're human nature, we react. You know, Mark alluded to earlier about the headlines, right? As the headlines are saying the big issues in the markets or whatever the breaking news is, we tend to react to that. Now, I've been doing this, as I said, for over a dozen years now. Prior to COVID, I was on roughly 60 to 70 planes per year. So over that period of my career and other traveling, I like to think I'm a seasoned traveler. However, I would say every plane I've ever taken has had some degree of turbulence. And every time I feel turbulence as a human, I react. I quickly jerk and I'm like, oh, what was that? And I realize, okay, it's an air pocket, that's normal. Sometimes the turbulence is lighter, sometimes it's bigger. But I have confidence in the pilot to get me to my destination. And just like investments, we get those bumps in the markets. Some are bigger, like we've experienced so far this year, and some aren't as big, but those are normal. And we trust our financial advisors and our portfolio managers as the pilots of the plane. They are going to adjust the altitude or the flight path, but make sure that they continue on your destination. Because imagine if an airline can guarantee a zero turbulent flight. So you buy that ticket, you land, you're the best flight you've ever had. You open the door, you've arrived in Alaska, but you're packed for Hawaii. Great flight, but you didn't get to where you needed to be. The destination is key, and that is more important with investments. It's about the destination, what your individual goals are, and making sure we continue on the path to those goals. So far this year, we've had a bumpy ride, as I said. We're in a bear market, which is more than a 20% drawdown for the S&P 500 earlier this year. The max drawdown happened mid-June, where we hit roughly 23% drawdown. Bear markets, those 20% drawdowns are rare. Going back to the early 50s, we've only had 15 of those drawdowns. That is a rare occurrence, but that could also give me an opportunity, because for the long-term patient investor, equity markets were essentially on sale. That's positive. Here we see the drawdowns in any given calendar year since the 1980s. Excuse me. Those blue dots are the drawdowns. That's where we see the risk in the markets. On any given calendar year, we see a drawdown of, on average, 14%. Now, of course, those are amplified by the big drawdowns when you see the big bear markets, right? The minus 30, minus 50. Those tend to coincide with, as I said, those big bear markets. The tech wreck, the great financial crisis. Those are big drawdowns. The 87 crash, right? Big drawdowns. We do not expect this to be a similar environment, right? The positives here is the green lines. This is one you want to focus on. The green lines are the return during that calendar year, the total return, despite the drawdowns. So the calendar year returns on average 80% or 3/4 of the time are positive and average 10% return. That is a positive news. So don't pay attention to the blue dots, pay more attention to the green lines. That's where markets are more positive than they are negative. Despite volatility, despite turbulence, the markets are arriving at the destination. Again, sometimes it takes longer, but it's important to focus on that destination. When we look at the probabilities of markets being up or down, we've looked at the last 50 years and looked at probabilities on different time periods. So daily chances, monthly, 1 year, 3 year, 5 year, 10 year. On any given day is essentially a coin flip as to whether the S&P 500 will be positive or negative. But as we hold our investments a little longer, that probability of being positive is amplified. Even at 3 years, we have an 85% chance of being positive in any given 3-year period going back 50 years. That's a very strong probability. The probability is on your side, right? It's in your favor to hold investments. And 3 years is not a long holding period. Even for those retirees looking and saying, well, I'm in retirement or near retirement, 3 years is a long holding period. I should get out. Well, the actual average mortality age in Canada is roughly 86 years old. So the average retiree retires at 65. That means the average retiree is in retirement for 21 years. That is a lot of 3-year periods in that 21 years. So even retirees do have time to withstand some short-term movements because markets, again, are up more often than they're down. In addition, we want to make sure we are time in the market, not timing the market. You know, imagine we went back and had money to invest, and we, in hindsight, invested in at the worst period in recent history, right before the great financial crisis, the peak of the market back on October 9th, 2007. We invested that day and then just closed our eyes. Essentially, we hibernated and woke up June 30th, 2022. We looked at our holdings. We would be up almost 226%, roughly 8.4% annualized. That is despite what we consider 3 contentious U.S. elections, 2 recessions, 2 bear markets, 6 corrections. There was a lot of reasons to sell during that period, but we were still up annualized. You know, we had other geopolitical risks such as the European financial crisis, right? We had ISIS and oil prices at $145 and minus 35. We had Ebola, the COVID-19 pandemic, of course, Middle East tensions, trade wars between the US and Canada. We also had a risk of a nuclear war with North Korea. There's always a geopolitical or a headline reason to sell. The important thing is we don't make that knee-jerk reaction and get off our destination, get off the path, right? Stop for good or return home, right? We'll never get to our destination. That is key. And more importantly, when we're looking at investments in that journey, over the longer term, it's important to look at quality businesses, right? Not trying to time or jump on the hottest stock, right? Someone has said recently that investments should be like watching paint dry, right? It should be boring. Good quality businesses over time compound, and that's where you benefit over a longer period. It's not trying to chase the hot stock, right? If you want to be excited about it, you should be going to the casino or going to a theme park and riding roller coasters. Investments should not be necessarily exciting. You want to be boring. And I think when listening to Jonathan Popper and his team's methodology, you'll realize that they are not trying to capture those exciting companies necessarily. They're looking for good businesses that will grow over time and add value to a portfolio. They're not trying to capture lightning in a bottle and those hot stocks and momentum or moves. So I would urge you to pay attention to his portion of the presentation, and he'll give you very good insight on how they manage money and how they are putting insight into what they're doing right now to try and take advantage of some of the material market dislocations that exist right now. And I think why he's excited about this market, despite the volatility we've been facing so far this year. So Mark, maybe I'll turn to you and see if there are any questions.
Thank you very much. Really appreciate it, Kevin. Here, I'm just going to move myself so I'm back on there as well too. Really appreciate you taking the time. Being able to listen to you and just hear some statistic about what's really going on out there is really, really important, I believe. So yeah, there are some questions that I've had sent to me beforehand that I'll ask, and I'll remind everybody else, if they do have a question, please don't be shy. Just run down to the bottom and type Q&A, and I'll ask that on your behalf. But we talked about inflation a lot, and there's a huge amount of conversations everywhere about inflation. Things are expensive. When this is going to end, when are interest rates going to stop rising? How is this going to impact the market and the economy? Can you maybe just give me some of your thoughts, or give everybody here some of your thoughts about your vision about inflation 12 months down the road, 18 months down the road? Do you think this is a long, prolonged worry, or is it just a short-term issue?
Well, inflation is clearly on everyone's mind, because really, unlike other years when we've seen, inflation calculations, this inflation is really hitting people's pocketbooks, right? We've seen, especially the price of gasoline at the pumps skyrocket as a result of many factors. One of course, is the price of oil and the cost of distribution, cost of importing it from the United States and other areas. Also, the cost of groceries as a result of what's going on in Ukraine, and realizing how much of a global food can sometimes start in that area of the world, such as grain and wheat. So that's important. What we're seeing right now is we're starting to see some positive momentum, meaning we're starting to see the slowdown in inflation. By all means, it is higher and lasts longer than I think anybody expected. But of course, just as we're getting improvements from COVID, we had that invasion in Ukraine, so that has exacerbated the issue. But we are seeing, as I said, we are seeing improvements. I don't think we're seeing, that 2% magical target by the central banks happening anytime soon. But I think the key is the rate of change is going to slow. And that's what inflation is calculating. It's the rate of change, right? We're not going to see gasoline prices probably go down to, $1.20 a liter anytime soon, or perhaps ever again. But we don't continue to expect the same growth rates, which is at least somewhat comforting, knowing that perhaps we've hit peak levels and the worst is behind us.
Perfect. Thanks a lot, Kevin. Really appreciate that. Now, I know in your presentation, you did talk about the market and the economy. So maybe just a couple of quick words to sort of expand on that a little bit further. The economy and the market, two different things. When there's some bad negative news out there everywhere about the economy, how does that translate into the market? And just talk a little bit about those two different ideas. It's always
interesting to hear people talk about the economy and recession or whatnot. And as I said, the market tends to be forward-looking, right? They're already anticipating the change in economic growth and the weakness in economic growth, and that's why a lot of the pullback happened earlier this year. At the same time, when you come out of recession, the market usually anticipates the end of recession way earlier than we are out. So typically, by the time we're told by the powers that be that we are in a recession, or that we are no longer in a recession, the equity market and fixed income market has already anticipated that and already changed. So we can't wait for the economy to tell us. And that's why we have to have some data that gives us advanced notification of the changes or the trend. And that's what we look at, is that idea is early this year, we saw things weakening regardless of what was happening. We knew the data was weakening. We saw it in past periods. We knew data was weakening. And then we see it improving. We see the bottoming coming up, and we know that equity markets are likely going to price that in. So it's important to understand how they impact each other, but also make sure that we're not trying to time it again. One of the risks, and I think this is why we see markets fall, is when the economy slows down, that impacts corporate earnings. And the stock market essentially prices in what they believe, the market believes the fair value of that company is and their earnings going forward. So if the company is going to make less money because they're selling less widgets or whatever the product they're selling, obviously the stock is going to take a hit. That doesn't mean the company is bad. It means it's a temporary impairment on their business. That doesn't mean a longer term. And sometimes the price reaction is overdone, right? The pendulum swings too far. And actually that's where the opportunity to pick up attractive companies at a cheaper price is really, really exciting.
Perfect. Yeah, thanks a lot, Kevin. Really appreciate that. I think that's one thing, the market and the economy, they're two different things, and we have to talk about them separately, even though they do obviously, meld in together at certain points as well. Another question that I've got, and this is relating to, Canadians going traveling. I heard one statistic, which I thought was really interesting for Target. One of their fastest growing product lines, or not product categories, year-over-year growth was luggage. One of the standouts, which is kind of interesting. So I would assume people are wanting to get away and get out of Canada, travel, all those travel plans that may have been canceled over the past couple of years, get back to it. So when Canadians leave our border, we have to see what the value of our dollar is outside, and a lot of people going to the United States. Can you talk a little bit about the US Canadian dollar issue just now?
Yeah, for sure. And I think there's a lot of surprise, perhaps over the last 6 months or so, or even longer. The fact that the Canadian dollar, the loonie, hasn't really moved much higher because oil moved higher. And a lot of Canadians expect the loonie to move with oil. Now, that's typically over a longer period of time. Yes, it does move with oil prices. But one of the issues we've had this year is this notion of higher risk in the markets, right? There's that fear sentiment. And when the markets have that fear sentiment, there's a natural gravitation to the US dollar as a flight to safety, as a refuge for investors. And that's why the loonie has not moved higher. The US dollar has actually moved higher against the broad basket of goods, and is much higher than people would expect, I think, normally. We would expect that to start to reduce. We expect the Canadian dollar to start to revalue higher, even at current oil prices. Even if oil went down to $90, we would argue the Canadian dollar is still slightly undervalued. So there's nothing wrong with the Canadian economy or Canadian dollar. It was really just as a result of what the US dollar was doing and the way the calculation and the comparison is done. So our expectation over the next, call it 12 months or so, is the Canadian dollar to revalue a little higher towards the 81 to 83 cent range. Not materially higher, but a little bit higher from where it is. So at least a positive trend for those that are looking to plan vacation over the next 12 months or so down south.
Perfect. Yeah, thank you very much, Kevin. Really appreciate your comments. I know before we move on to Jonathan, I know Mo wanted to make some comments, but thank you very much, Kevin. Always good to hear from you. Always good to see some of these new slides that you put together to give us a little bit more of a context on what's actually going on out there in the economy. So really do thank you very much a lot, Kevin. I'll pass it over to you, Mo. I know you had some wanted to make some comments before we move on.
Yeah, first of all, thank you so much, Kevin. I think folks really appreciate seeing that really awesome core information you share. And one of the things that I wanted to draw attention to our audience is one of the biggest things we hear from people during times of economic struggle or down markets is, what can I do? And psychologically speaking, we all want to be productive. We all want to do something. If we're struggling in our finances at home, we know we can save more, we can do other things, but people want to see, what should they be doing with their portfolio? And often our answer to them is, look, you are already doing amazing things because you have chosen not to manage your own money yourself. You've actually done more than you can imagine, because behind the scenes, as we're sitting here speaking about it, gentlemen like Jonathan Popper and Alan Wicks and his team are making incredible changes and portfolio adjustments, and they're active and busy and they're working on your behalf. So that's how I'd like to lead into Jonathan Popper with my clients, is to say, you're not doing anything. You're actually extremely busy and lots is going on. And so as you can introduce our dear friend Jonathan, who we've worked with. I think, Jonathan, I've worked with you longer than even Mark. Or probably.
It's been a long time.
Yeah. So anyhow, I just want to pass along that what people are doing is what this man is doing for them. So Mark, would you please carry on? Thank you.
Perfect. Yeah, thanks a lot, Mo. So true. So true. Professional money management is definitely a very difficult thing to do. And if you don't have a team to do it, it's very hard. So Jonathan Popper, I think a lot of you may have met before, or definitely heard speak before, but he's senior portfolio manager with Manulife Investments in the Essential Equity team. They manage now, I think, near $30 billion in assets under management. They've been doing it for longer than I've been at Manulife. And I know, Mo, you had said 24 years. It was 23 years this past February. So we're 23 and a half years. Time goes by quite quickly. And the Essential Equity team, I've known my whole career. And what I like about them is their process doesn't change. They don't change it. Well, I guess they adapt, I should say, but they don't make wholesale changes because of some specific swing in the market towards commodities or towards banks or towards, energy. They look at good businesses, and most importantly, they compile a portfolio of good business very specifically to give people good, prudent growth over the long run with good risk-adjusted returns. And Jonathan Popper, I think, is going to go over his process. It's going to go over how they have been so successful for such a long period of time and how they can continue to repeat it. And again, there are that question and answer area down at the bottom. Please feel free, ask away. But with that, Jonathan, I'd like to pass it off to you to start your talk. Thank you.
Excellent. Thanks very much, Mark and Morris. It's a pleasure being here. And yeah, for us, as both Morris and Mark mentioned in the introduction, we are staying the course. And Mark alluded to me being part of a team. Before I get into the process, I just want to reiterate, we have a very deep and experienced team managing the funds you're invested in. We're a team of 11 individuals. The 6 senior portfolio managers have all worked together for over 15 years. 4 of the 6 senior portfolio managers have worked for over 25 years in the industry. And in fact, the Manulife Monthly High Income Fund is coming up to its 25th year anniversary next month. So I think that's really unique that you have a consistent management team using the same process with a 25-year track record. Why is that important? It's important because we've experienced a lot of good times, but we've also experienced a lot of negative volatility like we're experiencing today. We've managed through those negative volatility before. We will manage through it again. Our process is very deep, and we are focused in on buying individual companies. And one thing that gives us pause, which is fabulous, is the companies we're invested in are not broken. The companies we invest in are meeting the earnings expectations that they've put out for their guidance last year, the year before. And in many cases, as they've come to market, including some companies reporting this week, they're absolutely increasing what they're expecting to earn for this year and years beyond. So you can imagine in this doom and gloom framework, our management teams are very constructive about the future. Now, there's a disconnect. there's a disconnect, obviously, between companies performing and what people are willing to pay for a particular business at a particular point in time on the public markets. And as I think Morris in the previous introduction mentioned, you can't time the markets. We have no crystal ball that's going to tell you if the market or if a business valuation is going up or down. But I want to reassure you that the businesses we're invested in are fundamentally strong. They are either number one or number two in their industry. They have very low debt. So we were talking about inflation, or we were talking about inflation in the previous question with Kevin. All the companies we're investing in can take price increases over and above the cost of inflation. Our businesses have low debt. We're in a rising interest rate environment. It's not going to have as big an impact as some other companies with bigger debt. When you look at our portfolio, the companies we're invested in today are the same companies we had prior to COVID, during COVID, and these companies came out of COVID looking as good, if not better. So it gives us comfort. Now, unfortunately, I can't see everyone, but if we were all together in a room, I would ask you guys to participate, and hopefully you'll participate in just reinforcing with this example to prove to you that the markets are inefficient in the short term. And I want to play a little game. And the game is this. Let's forget this year, 2022, because the example of what I want to tell you happened at the beginning of COVID in 2020, and the deal closed in 2021. But before I tell you what happened, I want to make an assumption and just play along with me here in this little story that each and every one of you over the last 2 years during 2020 and 2021 wanted to sell your house. And so you went to a real estate agent. And as Mo mentioned, I 100% agree. You're already ahead of the curve using an investment professional, using an investment consultant like Morris and Brad and Chris. Because the do-it-yourselfers, we saw it again last month. Last month, we saw more money come out of the market at the completely wrong time. And so, given that you use a financial service professional, I'm going to assume in this story you use a real estate professional, and you tell your real estate professional that you're interested in selling your residential house. And the real estate agent suggests that you list it at $1 million. And I hope I'm not being Toronto-centric, but I imagine in the interior of BC, $1 million is probably a good average example on real estate. And so your real estate agent puts your house on the market on a Monday morning for $1 million. Is that house during the calendar year 2020, 2021, even the beginning of 2022, forget about the last 8 weeks, but is that house going to go for more than $1 million, less than $1 million, or the $1 million? I'm guessing, and maybe Mark, you can jump on and nod and not nod, or Mo, that it's going to go for more than $1 million.
It definitely.
Sorry?
Yes, definitely. In the Okanagan, it's been.
Definitely. So if I came to you and offered you $800,000 that first morning, you would probably hang up on me. And rightly so, because a 20% discount is so out of whack. But why I share this story with you is because in April, May of 2020, Brookfield Asset Management, which is a large international banking business, sort of like the Canadian banks, but more broad on the institutional side around the globe. And they own infrastructure assets like bridges and ports and railways. And they own energy, renewable energy facilities like hydro dams and wind dams. And they also own the public real estate company with real estate around the globe. And they offered, they came out and said, we want to buy what we don't own of this real estate company for a 25% discount to net asset value. And all us smart Bay Street investors said, oh, it's way too little. So they came back and said, we'll give you 22%, we'll bump it up by 3%, but it's still 22% under net asset value. And the Bay Street investors all agreed to the deal. And so that should just reinforce to you that over the short term, the market is irrational. Think about would you sell your house at a 22% discount to what that agent suggested? Probably not. But that's what happened in the public markets in April of 2020, and the deal closed in November of 2021. And so that's really where we feel we are with our businesses. Very good, high quality businesses, but just being oversold in the market because of macro conditions that what Kevin was talking about. And so how do we go about just on a very high level managing our portfolio very quickly, you know? And for those of you that have heard me before, nothing has changed. You know, we want to make sure we are managing a portfolio, staying away from operational risk. And what's operational risk is exposure to commodities. And now what's really driven the Canadian market over the first 6 months of this year has been commodity prices. But I just don't know how to determine what the value of a barrel of oil is worth or what a ton of copper is worth. And unfortunately, these commodity businesses go up in value very slowly and down very quickly. Think about walking upstairs or taking an escalator and then taking an elevator down. So I can give you examples of bellwether energy companies that were up over 60% on a year-to-date basis earlier this year, but are only up 25% today. Or a commodity business in the material sector that was up over 66%. On June 7th, you were up over 66% if you bought this stock at the beginning of the year. If you still hold it today, that stock has a negative return on a one-year basis. And so you can see how quickly that volatility can move in the marketplace. And for us, we just don't have a strategic advantage to try and determine what the underlying value of a commodity price is. We cannot, for 25 years, put up very consistent numbers and have exposure, direct exposure to commodity risk. It's just not probable. As you're asking your advisors today, you know, why don't we own more energy? Well, if you could time the market and you held it for a year, you would have been doing very well. But if you extend that holding period to a 3 or 5 year time horizon, you're actually not doing so great. And so when you look at a company's earnings, how confident are you that a business is going to generate their earnings like they are today in 3 or 5 years? I like the comment. I don't want to call anyone out, but I heard on the call earlier, I don't think oils or gas is ever going back to $1.20 a liter. You know, that's what makes a market. There are a lot of people right now with recency bias that, you know, energy is up, therefore it's going to continue to go up. But if we're in the mind frame when energy is going down, people always think, oh, energy will go down. We need to buy businesses with visibility on their earnings stream. What we do all day, every day is analyze individual businesses and try and determine how consistent a company is at making money today, tomorrow, and the next day. And so we're going to stay away from companies that are price takers. We want to be invested in companies that are price setters, that can increase the price. And when you look at our businesses, you can see that none of them are seasonal in nature. None of them have a product that will expire. And so that gives us reassurance about the repeatable nature of a company's earnings. The second big aspect we really want to stay away from is having companies with a lot of debt. And this is just magnified in this environment with interest rates going up. But imagine with interest rates going up, it's going to cost you more to service your debt. And if you have a lot of debt, it means that you're going to have to use more of that free cash flow to service that debt. And if you have to use more of that free cash flow to service debt, you're going to have less to spend elsewhere. It's sort of like when you look at Walmart or Target and you hear the basket syndrome. As it costs more to fill up your car with oil, you have less to fill up your basket at the grocery store, Walmart, and Target. And so their sales are going down. The third avenue where we really want to make sure that we're protecting you as well in our process is to make sure that we're diversified. Making sure that the portfolio is spread out with as many different risks as possible. And when you see the Toronto Stock Exchange is up today or the Toronto Stock Exchange is down today, what does that mean? Well, it means the companies that make up that basket in the stock exchange has either increased or decreased. But what they don't tell you is 19% of that TSX basket is made up of energy. One risk. If the underlying price of oil is going down, I don't care if you have one energy name or 40 energy names, it's going to be pretty hard for those businesses to increase in value. 17% of the index is made up of materials. So you nearly have a third of the index made up of commodity exposure where management has no say on the price they're going to get for the product they produce. And that's concerning to us. So we're going to make sure we're far more diversified. And then the final aspect of making sure that we're doing our job is just make sure we pay the right price. We can buy the best company in the world, but if we pay too high a price, we might never make a return for our unit holders. And that's not what we're in the business of. We want to make sure that we are paying an appropriate valuation for that business's cash flows that they're generating. So we spend all day, every day, analyzing those individual businesses' cash flows. We talk to management. You know, one of the questions earlier that Mark asked Kevin was about inflation. Well, we come about analyzing inflation from a company-specific point of view. Does a company have high barriers to entry or low barriers to entry? Does it have high market share, low market share? Does it have pricing power? Does it have customer diversification? All these characteristics are key in determining how a company can increase a price for their consumer. Imagine a railway company or a garbage collection business and how they can determine price compared to your gas station at the corner. You ever notice that whether you go to any one gas station in the city, they have the same price? There's no competitive advantage. There's no pricing power. So we want to make sure that we're investing in businesses and paying the right price. And over the long run, we will be able to protect your downside and hopefully make a bit of money as we go along. And before I hand it back to Mark and Morris for questions, I want to reassure you as well that not only am I the portfolio manager, I'm the unit holder. All my equity exposure is in the dividend income fund that I know Morris uses, the monthly high income fund that I know Morris uses, the global monthly high. I'm not sure if that's in some of your portfolios, but we have 6 different retail funds, and that's where I have my equity exposure. So the statements you received from Morris and his team are the exact same statements that I've received for my family's well-being, for my benefit. We're 100% aligned. We eat our own cooking. So I'll stop there and see if there are any questions.
Thank you very much, Jonathan. Yeah, I really appreciate all of your comments. And you made a couple of comments about managing money. It's not as simple as just buying one stock and selling it and buying it and selling it again. I mean, you talked a little bit about the conglomerate approach of how you put together portfolios, because each specific stock, there's a reason for that being in the portfolio to kind of counterbalance some of the other risks that you might have. So if you could maybe just talk about that conglomerate approach of how you view an overall portfolio, I think would be really good for people to hear.
Absolutely, and it's an excellent question. And I guess we want to make sure that when we're managing money and that time frame is not everything works all at the same time. There are unfortunately going to be bumps in the nights. We saw it with COVID. Imagine if you had a portfolio. Mark, you were mentioning everyone's flying right now, but look at the airline stocks. Imagine if you owned airline stocks and hotel stocks and leisure stocks and airline businesses prior to COVID. You would have got slaughtered if you were overweight. So we're making sure that we're very well diversified with no one segment of the business more than, or no one segment of the economy more than 10% exposure to the index. And we look at it from a sub-industry point of view. And a sub-industry, you have in the Toronto Stock Exchange 11 sectors, say industrials being one. And under the sectors, you have industries, where transportation industry would be one. And then under the industries, you have a sub-industry where you can have rail exposure, ground exposure, and air exposure. You can get that if something happens to an airline, how's it going to affect a railway? It's not. And so that's where we come about diversifying the portfolio.
Thank you very much, Jonathan. I think that's really important to know that, building portfolios is definitely a full-time profession. It's not just picking and choosing the stocks individually. We do have one question on here. So can you comment on maybe a supply shortage and maybe specifically on semiconductors? And do you think there's any shifts in the global market in terms of production capabilities in that space?
Yeah, absolutely. And we're seeing, with the car inventory issue and any product, any durable good that needs semiconductors, North America is trying to resolve that. We're seeing it's a political issue in Congress. These are very big, expensive facilities that need a long lead time to manufacture, to fabricate in the States, to get up and running. So it's not a solution that can be addressed overnight. There needs to be all sorts of guarantees. A semiconductor business isn't coming to the States without some sort of tax benefit and financial backings from the government, and then it becomes political. So there's no easy solution, but rest assured, we are on top of this. And the nice thing is, again, we have at times some auto suppliers, but we're aware of these situations and we're aware of what's contributing to the revenue of our businesses, that, regardless of what happens, we are well balanced in the portfolio. So it is an issue. There's not enough facilities to meet the capacity. As we go to the Internet of Things, there's only going to be more demand as every household electrical item is going to talk to your central smart home monitor in the future. You think about, you can start your fridge or stove, you can turn your stove on half an hour before you get home to boil water or something. These all need semiconductors, and there's not enough capacity right now. So it will arrive, but it's not an overnight solution. But as Kevin mentioned, the market prices these things in before it gets to Main Street already. By the time we're talking about, capacity's here where we don't have issues anymore, the companies that will have benefited will have already had that lift.
Perfect. Thanks a lot, Jonathan. I got another question here just about some of the holdings that you have. You've got obviously a broad diversity of holdings, but maybe can you comment on some of the names that you feel are, I guess, for lack of a better term, exciting right now? And I know we don't want to talk about investing to be exciting. We want to be boring, but some of the ones that you might think have some really good prospects and you've got some good forward vision of their earnings.
Yeah, but I think the great thing is when you look at the whole portfolio as a whole, that's what we're excited about. When you look at specific holdings, you look at our top 10 names, very diverse, from garbage collection businesses to railway companies to software companies to healthcare businesses. We have the whole platform of what's really moving the economy forward. And really, since the beginning of the year, priced at far better attractive valuations than they were just 2 months ago.
Perfect. Thank you very much. Yeah, it is a portfolio approach that you need to look at. There's another question coming in here and talking about the conglomerate strategy. You know, when you look at the TSX and maybe other global markets, would you have any thought to overweighting Canada, overweighting the United States, or anything else? What is your view when you look at, I guess, macro market?
Yeah. So we aren't top-down macro economists. We definitely take that into account, like I said, with inflation and interest rates, but we're really looking for that bottom-up company opportunity. If I have two businesses, both that can make 10% and lose 5%, one in Canada, one in the States, I'll stay in Canada being the home bias country. But say those two examples, Canada's up 10, down 5, and the US is up 15, down 5, I'm going to be in the US. And then we also have an active hedging strategy to protect you from the US exposure as well.
No, that's a good point. Looking at your bottom-up stock pickers, putting together a combination of stocks. Now, you didn't mention this beforehand about interests aligned. I think that's really important. I think for many, many years, a lot of people are thinking about that. The professionals, you know, are in a different portfolio and they're compensated somewhat differently. And I think the way that you and your team are compensated, I think, is truly linked to the investors, the unit holders, and you're incented exactly the same way. If things go up positive, you get compensated. So could you make a couple more comments on that, please?
Absolutely. You know, again, we think it's so important to be aligned with the unit holder. And as such, you know, if the portfolio of these, if a security is good enough for me, it's going to be in the portfolio. It's not one of these portfolios where, oh, it doesn't, the security that I own doesn't meet the mandate of the portfolio. So I'm going to buy it personally and skip it from the portfolio. No, the number one goal of the portfolio is to preserve capital. And as such, you know, we look at this as making, you know, we have all our own money in it and we're going to do what's in the best interest of this portfolio. We also get compensated, as I mentioned, the number one goal being preserving capital. If we don't make a positive return, even if we beat the index, so relatively, we've done a good job. The Toronto Stock Exchange is down 10% and we're down 2%, I won't get a performance bonus because I haven't achieved the number one goal of preserving capital. And our retention bonus is invested in units of the funds and locked in. So, you know, we are very aligned and we are very focused on trying to do everything possible to maintain those absolute positive returns.
Thank you very much. I think that's really, really important to talk about for sure. Is there any other questions on there at all before maybe we pass it off to Mo, Chris, and Brad to...
Well, I was just going to say, Mark, on the interests aligned, absolutely, you know, Jonathan, we speak to our clients very clearly about that. We personally, our entire team, utilize all the same portfolio specialists that we have for them. What's good for the goose is good for the gander. We eat our own cooking. Our parents, our siblings, our families, our spouses and children, we're invested in the same professional expertise, very same teams. And that is really a sign of true belief in what you're doing. One of the things I wanted to draw attention to for all of our friends and clients and guests on here is it's pretty rare in a lot of industries today that you have professionals that have been in the same seat for 25, 30 years. And the only reason Chris and Brad haven't been there yet is they're not old enough to have had that many years. But at the top of our screen, Jonathan, myself, and Mark, along with Kevin, I mean, it's rare you find people that just don't change their career. And when you find that, you know that there is a stick-to-itness, there is a capacity for strength and for wisdom. And I think that that is a real leading indicator for us when we choose portfolio teams. As we see, they're long in the saddle. They've been through several cycles and they have a process that just doesn't change. And that's one of the things with Jonathan's team that we have just found incredible through, well, since all the way back to about 98, I believe, when you guys started the Mohai Fund.
Yep.
97, 98?
97, September
Yeah.
97.
Right. So yeah, I just want to point that out.
Thank you very much. Jonathan, I really appreciate you taking the time.
Thank you.
Always good to hear from you again. And I know I've been at Manulife like 23 and a half years, and I've heard from the team since 1998 or end of 1998. And it's amazing to me to keep hearing the same process. It doesn't change, it works. And I always like, as soon as I start hearing that there's a change in the process, I'll get worried. But you don't change your process; it consistently works, and that's just what I love about the team. So, thank you very much. Really appreciate you taking the time to come and speak to all of Matt and Associates clients. Really appreciate it. Mo, if you or Chris or Brad have anything else to close, I'll just pass it off to you. But from the Manulife investment side, really do appreciate you just including us in your business. We really appreciate that. Having time to speak to the investors out there, to give them some knowledge. Hopefully that's different from the news, to help them keep that discipline, to stay invested. Professional advice is extremely important. It really helps not only pick the right managers like Jonathan, but they get a whole bunch of information like Kevin and a whole bunch of other sources to help you manage to your goals, whatever it may be, short, midterm, or long term. And the professional advice always adds value. It is statistically proven time and time again. So I enjoy working with you. So thank you very much for having us included in your business.
Well, it's our pleasure, gentlemen. And to all of our guests and clients and family who's on the call, I think what we continue to learn is just how complex these markets are. My goodness, there is so much going on. We continue to learn that retail investors really should not be managing their money or making purchase and sale decisions because the psychology is just so complex. And this is the reason why these trusted teams do such a fantastic job for us, because they lead us down a logical path, disconnected from the emotions of the moment. And that's what I love so much about the consistency that they provide for us. The legacy media, as everybody knows, has been providing such poor information in the last, well, maybe 15 years. It gets worse and worse. And there's a lot of information that they're providing, which may not be accurate and may have an angle to it. So we really, providing people like Jonathan and Mark and Kevin, really want to give our clients access to that which they are not getting in the real world out there from the legacy media. So we're hoping that clients are seeing a different side of the story that they wouldn't otherwise have access to. So many of our clients tell us their friends and family don't hear any information from their banks or their advisors. So that's what we're trying to do, is give you direct access to some of these leading experts. These guys are on BNN. They're regularly hosted on that network. Some of the top experts in the industry, and they're who guide us with your money. And we have numerous of these managers from many different firms. So to have them here in person for you is absolutely fantastic. And we're going to continue to try and do this a number of times throughout the year. So please do watch for invitations in our newsletters. And when you come in for meetings, we want the best for you. And we're also going to have a lot of recordings available. As time goes forth, we'll try and have a library of recordings so you can watch them again and again. And on behalf of our team at Matt & Associates, thank you so much for your trust and confidence. As I say, you're the reason that we have an amazing life, an amazing career, and we have a passion for this. And so thank you so much for your trust and confidence. Brad, Chris, and I and the team here, we're going to take you into the future. We're going to walk with you again through good and bad markets. And we're not changing the process. We're continuing to do what you have known us to do for decades. And we're just so thankful for you. So I'm just going to turn it over to Mark and again, say thank you so much, and hope everybody has an amazing finish to their week.
Thank you very much. I know Jonathan has had to go. He sent me a message. There was something going on at work that he had to run out to. And when you manage $30 billion, if someone has to do something, go ahead and do it. So I did thank him very much. I really appreciate the time for having us on the call, Mo, to speak with your clients. Pleasure to work with you for all of these years and to continue to do so. Manulife Investments, the investment side of Manulife, will always be there to answer any of your questions. So I always find when you hang up a call, you might have a question that pop. I wish I asked Kevin this. I wish I asked Jonathan that. No worries. Send that over to Mo, Chris, or Brad. They'll pass that over to me and I'll get it to either Jonathan or Kevin, or maybe there's somebody else at Manulife that may be able to have a good perspective and an answer on that question too. So continue to do that, and the flow of information between Mo, Chris, and Brad and Manulife is always going to be there. So really do appreciate. Thank you very much. Hope you got some great information from this call today. And as Mo said, we'll definitely continue to flow the information. So appreciate it.
Goodbye, everybody.
Thanks, everyone.